Look, I hate to be the guy who rains on everybody's parade. I really do. Everyone's popping champagne right now because gold just hit a record high. My phone is blowing up. Guys are texting me, Jimmy, we're rich. Gold's going to the moon. And yeah, looking at the 1-year chart, it looks great. Up 64%. Absolutely incredible. But I'm a simple guy. I like history. And I'm looking at a different chart right now. And it's the 50-year chart. And dude, I'm seeing a signal here that looks exactly like 1980. And you know what happened in January 1980? Right after this signal flash, gold didn't go to the moon, it fell off a cliff. It crashed 65% and destroyed people's life savings. So here's the question. Is the party over? Are we about to walk into a buzzsaw? Or is this time actually different? We're gonna look at the math and not the hype, because there is a $38 trillion reason why 1980 might not happen again. But there is also a tax trap the IRS set for you that nobody's talking about. So let's look at where we stand. If I just show you the last year, gold looks like a rocket ship. It beat the S&P 500, it beat real estate, it's the MVP of 2025. But now let's zoom out. When you look at the 30-year or 50-year chart, I mean, look at this thing. It's absolutely vertical. And physics is a real thing, right? Gravity exists. And the Army Rangers, they taught us that hope is not a strategy. And hoping that this line just keeps going straight forever, that's not a strategy. So to figure out if we're in trouble, we got to look at the last time we were in this exact spot, 1980. People talk about the 1980 crash all the time, but they usually get it wrong. They say, oh, gold crashed because it got too expensive. And no, that's not it. Gold fell because the US dollar got its act together. See, in the late 70s, inflation was nuts. It was out of control, and people didn't trust the dollar. So this guy, Paul Volcker, the head of the Federal Reserve back then, he's a tough guy, big cigar smoker. He got the crazy idea to fix it. But he didn't do it in little baby steps. He took an absolute sledgehammer to the economy. He raised the interest rates to 20%. Can you imagine that? Think about your mortgage right now. Now imagine if the bank called you and said, hey, your rate is now 18%. You'd be toast. Businesses would close. It was brutal. But here's the thing, it worked, because rates were 20% and inflation was 14%. So if you held cash in a boring savings account, you were making a positive real interest rate. You were making a 6% profit by just sitting on cash. Why hold gold, which pays you 0% interest, when cash pays you a guaranteed 6%? You wouldn't. It's the math. So everyone sold their gold when confidence in the dollar came back and gold collapsed. Then we have 2011. And I remember this clearly. I was buying properties back then and gold hit $1,900 an ounce. Everyone was screaming hyperinflation and money printing and quantitative easing and QE. They said the dollar was going to zero, but it didn't happen. Inflation didn't show up. The economy stabilized, the stock market started ripping, and slowly the Fed started raising rates again. Gold didn't crash overnight like in 1980. It just kind of bled out. It was a slow, grinding, painful decline. It fell 45% over 4 years. It was just brain damage for anybody holding it. And so now here's the 3 rules of the crash. So if you like keeping things simple, when you look at history, gold crashes when 3 things happen at the same time. Real interest rates turn positive, cash pays you to hold it, the dollar gets stronger, confidence in the government comes back, and if those 3 things happen, gold is toast. Now for the reality check in 2026. So let's look at today. Do we have all those 3 things, or are we about to see a repeat of 1980? Factor 1, real rates. Right now, the Fed's fund rate is 3.75. But look at your grocery bill. Look at your insurance bill. Look at the cost of rent. Inflation, the real inflation, not the government number, is way higher than 3.75. If your bank pays you 3%, but inflation is eating 6% of your purchasing power, you're losing money every day. We do not have positive real rates. We have negative rates. Cash is trash right now. So advantage there goes to gold. Factor 2, the debt, the big one. This is the one that keeps me up at night. In 1980, the US government had very little debt. The debt to GDP ratio was like 30%. We were lean. We could afford to raise rates to 20% to fight inflation. Today, dude, the national debt is over 38 trillion. That is 120% of GDP. And here's the math. And this is simple arithmetic. If the Fed tried to pull a Paul Volcker today and raise rates to even 10%, the interest payments on the $38 trillion debt would act like a nuclear bomb on the budget. It would consume every tax dollar they collect. The government would literally default. So they can't raise rates. They are trapped. This is called fiscal dominance. It basically means that the debt is so big, the Fed has lost control. They have to keep rates way lower than inflation to inflate away the debt. So this is another green light for gold. Factor 3, the whales. Here's another thing. In the past, central banks were selling gold. Today, they are buying it hand over fist. China, India, Poland, Singapore. They are stacking gold bars. They are doing this thing called de-dollarization. They see the $38 trillion debt They get nervous and they swap dollars for gold. This puts a floor under the price. But now I got to pivot for a second because there is one risk that almost nobody is talking about. And this is the practical advice, okay? This is the boots on the ground stuff. Let's say I'm right. Let's say gold doesn't crash. Let's say it goes to $5,000. You're happy, right? You decide to sell and cash out. You walk into a coin shop, you put 30 gold maple leafs on the counter, and the dealer gives you a check. But he also hands you a form. It's a form called a 1099-B. The IRS treats golds as a collectible. It's not like selling a stock where you pay 15 to 20% tax. The minimum tax rate on gold is 28%. It's hidden in the tax code under Schedule D. So think about that. If gold goes up, but inflation eats 6% of your profit, and then the IRS takes 28% of your profit, did you actually make any money? Or did you just kind of run in place? You got to do the math on the real return. And don't let the government tax you into poverty. So will gold crash like in 1980? You know what? My gut says no. And my brain says no. Not because I love gold, but the math for a crash just isn't there. For gold to crash, we need to have a strong dollar and high interest rates. And with $38 trillion in debt, the US government literally cannot afford high interest rates. Now, does that mean it goes straight up? No. We're probably in the scenario 2, volatility. You're going to see a 15% drop. We're going to see scary headlines. You're going to see days where you feel like an idiot for holding it. And that's normal. That's the price of admission for owning gold. But until the government balances the budget, which let's be honest, it's not going to happen in our lifetime. The conditions that caused the 1980 crash just don't exist today. The dollar is backed by confidence. And right now, the math is making the confidence pretty shaky. But here's the thing you got to understand about gold. It's strictly defense. It sits in a safe. It looks pretty and it protects your purchasing power. It doesn't pay you rent. It doesn't send you a check every month. And like we talked about, when you sell it, Uncle Sam is waiting there, waiting with that 28% tax bill. If you really want to beat inflation, you can't just play defense. You need an asset that acts like gold. It's real, it's hard, and you can touch it, but it actually pays you cash flow while you hold it. It gives you tax breaks instead of tax penalties. Now, usually that means buying rental properties. And I know exactly what you're thinking. Jimmy, I don't want the brain damage of rental properties. I don't want to fix toilets at 2 a.m. And I agree. And I don't want to do that either. But there is a way to own the deed so that you get all the tax benefits and the appreciation without any of the grunt work. I broke down exactly how this real estate automation model works in this video right here. Because honestly, the most expensive thing you can do right now is let your cash sit on the sidelines, doing nothing while inflation eats it alive.